Yeah, Happy New Year, Mike. Good to be with you. Look, I think, as you described, all the action's been under the surface. So, kind of looking at the major averages has been a little bit of a sideshow if you're running a real, portfolio of stocks. And that's really where we've been trying to spend most of our time the last, 4 to 6 months, which is trying to understand these rotations. And as far as the mid-cycle transition goes, we've made a lot of progress. A lot of these rotations really started kind of in the springtime. And then, of course, picked up in the summer when it became clear that the Fed was going to have to move. And so I would say the good news here is that, like, on the rates front, I think we've adjusted a lot. If you think about the high multiple stocks, they really started to sell off in early November. It's been a bloodbath for the last 2.5 months or 2 months. And so a lot of the damage there has probably been done in terms of the rate move, the fire part of our fire and ice narrative. Now, what we need to focus on is how much of the slowdown is in the numbers, okay? So as you go through the mid-cycle transition, the Fed comes into play, they raise rates or they tighten, that tightens financial conditions, multiples come down. But then you also have to adjust kind of earnings growth for, some industries and some companies. And I think that adjustment process is about to begin now as we go into the first half of this year when the comparisons are really difficult. We don't have as much fiscal stimulus as Sarah was saying, as people thought we might have coming into this year. There's some of these support mechanisms are going away. And so let's see how that goes. But my guess is that deceleration in growth is going to disappoint, and that could carry into the first quarter. And then once that's completed and we kind of normalize what the growth rates are, then the mid-cycle transition will be complete.
Do you think that there's downside, though, for like actual consensus earnings at this point for the year or for the next couple of quarters? Or do you just feel as if investors are kind of geared for even better than what's on paper?
No, I actually think the numbers will come down, not for all sectors. For the S&P overall, maybe there's 1% to 2%, 3%, downside for the full year number, something like that, because there could be margin pressure. That's where the risk is probably the greatest, not with the top line. But there are sectors like consumer goods and some of these areas where there's been a giant pull forward of demand where I think there's absolute downside. So for sure. And that's why, I do think it's going to be more idiosyncratic in here. And that's why we have more of a defensive bias. We're basically very focused on earnings stability, earnings achievability. Those are the two main factors I think that are going to work really well over the next couple of months.